Hello everyone. So on the behalf of Thai Global Summit 2020, I Nidhi Baushe, Executive Director, Thai Nagpur Chapter, welcomes all to the today's track on the topic, what makes a venture fundable. So there's a lot of things, there's a lot of insight, what makes your venture fundable. So it's an investor's perspective. So with that, I would like to introduce and welcome our moderator who will be moderating this session, Mr. Nitin Sachdeva. Nitin is a managing director of Delaplex, the USA-based IT company working into the development services, supply chain solution, and data science. And he heads the Asia Pacific region with a rich professional experience of over 2 decades. He is the current Thai Nagpur charter member. He specializes in a business process transformation and has been associated with a lot of organization as a mentor. Welcome, Nathan. So with that, it's my really a great privilege to introduce speakers of the track. Mr. R. Ramakrishnan. Rama is a chairman and co-founder of Exeno Capital, a niche investment bank with a presence in more than 50 countries. His cross-border mergers and acquisition franchisee is now a part of London headquarters investment bank, which is among the top 10 investment banks in the world as per the recent Bloomberg League table. Besides, he is also the co-founder of Quantum, a company focused toward turning around special situation assets and helping its strategic sales. Professionally, he is a CA and ICWA. He has also cleared the civil services mean and chose not to join the services. He is also angel investor, and his investing arm, Core Resource, is an early stage investor with a high touch model, which invests in the next disruptive businesses. He is also the past president of Thai Nagpur. As paying it forward, he is advisory board member of Vigyan Bharati, Indian Science Movement of Government of India, and Karyakarta of Vivekanand Kendra. Welcome, Ramakrishnan. So moving to our next speaker, Shashikant Chaudhary. Shashikant, past president, he's a past president of Thai Nagpur chapter, a serial entrepreneur, is now investor and a mentor. He's a funding and advising not only regular startup but students startup as well. He has invested in very interesting startup like shepherds.com, MobiContact, CarlQ.com, Location Guru. He is also the co-founder of Thrive. It's his 10th venture. He was the managing director India for Global Logic, which is now valued at 3 billion. He has over 30 years of experience in senior management and academics. A serial entrepreneur, has co-founded 5 IT companies. He has been instrumental in bringing Nagpur on IT map of India. Recently, Shashikant was awarded Global Nagpur Award Individual Professional IT in recognition of individual contribution toward Nagpur's development and improvement toward becoming a global city. With that, I welcome our third speaker, Dr. Tejender Singh Rawal. Dr. Tejender is a chartered accountant with an experience of more than 3 decades in investing and in mentoring startup as well as an investor. He is the founder of TS Rawal and Company. So with that, now without a further delay, I would request Nitin to take over and let's hear it from the Star Wars itself. Over to you, Nitin.
Thank you so much, Nidhi. Thanks for the introductions. It's an honor to be here on this platform on the biggest entrepreneurship summit happening globally across 60 hours of real life learnings being shared by a lot of experienced and successful entrepreneurs. And we are here with the right set of people who have been instrumental today and since many years when they started their career, since the early days, in shaping the lives and a lot of organizations across the globe with base at Nagpur. These people are actually global entrepreneurs. And the topic here for today is what makes a venture fundable. We all know what an angel investor looks, and there is a lot of gyan being circulated across the globe on the Google and other things. But at TIE, we make it with a difference. So we hear it from the experts, their perspective, and how we distinguish the organizations which are venture fundable. So with this, I would request Rama to please share his perspective on the topic.
Hey, good afternoon. Thank you, Nitin. Thank you, Nidhi, for that generous introduction. In fact, there is something extraordinary that happens when you are at the middle of a crisis, be it an economic crisis, be it a pandemic, right? Iconic companies are built, iconic companies and startups are built during these challenging times. Let me give you some of the examples which you already know, but just to give you in a perspective. In the 1970s, early 1970s, there was a recession in the US, which lasted for almost 20 years, 2 decades. This is when the dropout Bill Gates and Paul Allen started Microsoft, and we all know it went on to become the most valued company. Let's come to the dot-com bust of 2000. This was when Apple 2.0 got reincarnated. Steve Jobs came back and invented the iconic iPod, and the rest is all history. We all know that. Let's come a bit closer to the 2008 global financial crisis, Lehman Brothers crisis. There were two young boys, Brian and Joe, who were living out in San Francisco, not having enough money, so they thought of renting out their air mattress, from their living room, right? And in 2007. So what happened thereafter was, the explosive growth because of the global financial crisis. Everyone wanted to be frugal, and we all know the story of Airbnb, which became the most valuable private company. So this is what a pandemic, this is what a crisis does. So this pandemic, to my mind, is going to be orbit shifting for many startups, if we take it in that perspective. And therefore, investors are also looking at this pandemic from that perspective. They're looking at startup entrepreneurs from that perspective. We will see fast acceleration in technology overlapping in many ways. You will find artificial intelligence and robotics overlapping with nanotechnology, genetics, to make humanity go to the next level. The technological singularity is going to be tested in many ways. So startups, there's a beautiful opportunity out there to build something great in these times. Let me give you some of the small examples which are playing out in the garages as we speak. AI embedded robots are out there, would be there in the restaurants, right, delivering food. Robots will be at homes, right, cleaning your homes. There will be drones. Drones are already delivering pizzas and coffees as we speak. Obviously, there will be a whole bunch of startups like 3D printing happening at your backyard. You'll print your homes, polo T-shirts overnight at a frugal cost, and obviously the nanobots, right, which Elon Musk had done a demo day in August 2020. You'll have nano robots in your head. I mean, that is what the future is going to look like post-pandemic, Nitin. I mean, amazing times.
Thanks, Rama, for your perspective. I know you are always a big fan of technology and you lead from the core. And in the same way, we have Shashi here. Shashi is a person who has an experience of starting a lot of tech-based startups and scaling them to big ventures, and especially when there are student startups. So Shashi has been mentoring them a lot. We would like to know about his perspective and what he feels about how a venture could be fundable.
Thank you, Nitin, and thank you everybody for this wonderful opportunity. I think everybody has kind of their own, I would say, kind of a formula, or kind of the way of looking at these startups. The way I would look at it is, if any startup has to be fundable, then there is maybe a simple formula to look at is whether it's the startup has a business model which is repeatable. Is it scalable at the same time? Is it profitable? Is it predictable? Is it defensible? If you add those five, you get a fundable startup. Most of the startups, not that every startup is going to be in investment ready. And also, conversely, also that is true that all the investment ready startups do not get the investments. That's not true. In fact, if you look at the kind of the startups also, the investable companies, as they say, do not occur by accident. In fact, opposite may be true. And the companies or the startups which are investable accidentally become investable. I mean, that is also true. We have seen those kind of things over there. And in a typical, when the any investor or any VC he's trying to look at the company, his perspective is that what is the big story and what is the unique story of a startup. The big story is a big picture. How is the market evolving? What are the kind of the trades which we are seeing over the place? And in that big story, he's trying to find out what is that unique story of an entrepreneur. And in fact, he's trying to find out, what is the secret sauce? What is his unfair advantage? How uniquely the structuring of the business model is done. How he's going to sustain the competitive advantage. What channels are going to be he using? What are uniqueness in that? Can he really predict the intersection of the technology and what is that point? And can he, show that investor that picture? Inside that big picture, what is the unique picture of this startup? The moment they get to see that, the investor is more comfortable in investing in those kind of startups. So those are my 2 lines to start with.
Perfect, Shashi. Thank you so much. We have Tejinder with us. Tejinder has also written quite a lot of books on startups and the energy what a startup gives for the angel investors. So we would like to know your perspective, Tejinder, before we start with the actual panel discussion.
Thank you. Thank you very much, Nitin. And thank you, Nidhi, for introduction. And I'm happy to be here. Well, as Nitin said, there's a lot of gyan prevailing in, on the internet as to how successfully you can fund a startup and make a lot of money, and people give a ballpark figure of 25%, over 25% return on your portfolio and so on. And people give examples of companies where your initial investment, turned out to be a multi-bagger, it multiplied many times. Let me start with a very realistic notion. Let me tell you that many of the startups fail. Almost half of them are going to fail. If you ask me the statistics, and which of them are going to fail, not many people can make out in the beginning. So it's a tough call actually financing the startups. So half of them are going to fail. 20% of them are eventually going to return your original investment. About 20%. I may be slightly off the mark when it comes to statistics, but this is quite a realistic figure. About 20% of them are going to be, give you your return back. About 20% of them are going to give you a profit of 2 or 3 times of your investment. About 9% are going to give you a 10 times profit on your investment. And 1% out of your total startups are likely to give you a 20 times the return on your investment. And if you have not done your homework well, and you have not incorporated these 9% and this 1% in your portfolio, you may actually lose money. And a lot of people are actually losing money because they have not done the homework well. Being an angel investor is not just being a passive investor. It requires a lot of things. It requires a different perspective. It requires a long-term view of the situation. It requires you to be passionate about the business that you're investing in. It requires you to be a proxy entrepreneur who is relying on the integrity and the competence of another entrepreneur to deliver return in the business. And it requires you to have a proper asset allocation. Unless you do that, you could perhaps be a loser. You could think that 25% return, which is never going to come. So as we progress during the discussion, I would be talking about all those aspects. Nitin.
Great, great. Thanks, Dr. Raval. Before we deep dive in startup investing, it is important to understand why startups fail. Because you say that most of the startups do have a tendency to fail. And as per the average, 9 out of 10 startups definitely are on the line of failure. So, Rama, your perspective on this?
Good, actually, good, Nitin, that you brought this up, and good, Tejender, that you talked about failures, right? I was reading a recent report on failures on 101 startups that had failed, right? That had called it a day, right? Very interestingly, 90% of the startups fail, right? This is what you're saying, Nitin. In other words, 9 out of 10 startups fail. So it's important to understand the analytics why they fail. A good 40% failure happens if you do not have the right product market fit, right? What does it mean? In simple words, it means you're manufacturing, you're producing, you're trying to sell what the customer is not ready to pay a reasonable price for. So if you're not producing something for which customer is not ready to pay a price, meaning it's not a burning problem, then obviously that's not the right kind of startup, and we need to sort of figure it out or pivot in terms of looking at that startup or that idea in a different way, look at the pyramid differently. The other large reason why startups fail, another good 20-25%, happen because of the people's problem, right? What does it mean? It means that you don't have the right set of co-founding team. You don't have the right set of founding team. So what's the simple way of fixing this? What do we need to do, right? We need to have three key ingredients in the founding team. The first is obviously someone who's a visionary, who can see the future, right? Unlike a debt investment, a startup is a future, right? Looking into the future. So the CEO or one of the founding members should be visionary. He should know how to see the future. He should be the crystal ball guy, right? The second one obviously should be a hustler. Who's an hustler? A hustler is someone who understands the big picture, as well as someone who can come quickly down to the granular detail, right? Into the smaller detail, who looks at the God in the details, right? And obviously the third one is the hacker, right? Who singularly focuses on product, product, nothing else, right? If you have the right kind of DNA, if you have the right kind of founding team, obviously you can have a, if you have an epic team, you can definitely make a good startup. I mean, these are the 2-3 things I thought, very simply put.
Great. Coming back to you, Shashi, we have seen you investing in a lot of organizations at different parts of the globe. So, from your perspective, what is the funding criteria, or when can you say that startup is fundable? Can you give us the top 3 filtration criteria you apply for funding at early stage?
Yeah, at the end of this, the first cut, if you are trying to look at the startup, then you look basically three things, continuing from what Rama said. It's about first, are they solving a burning pain, or is this burning pain is for large enough people, and are they really applying a disruptive solutions, means 1/4 of the cost and 4 times the efficiency. If these three things come together, that's a primary filter where we look at, okay, this is something good, you should have to look at it. It's not about, the burning pain about the large enough people. I mean, that's what we talk about market, right? And in terms of that market, it's not the market size today. We, as a filtration criteria, as an investor, we have to look at whether this market is growing. Not if the market is declining, then it's an issue. The problem they are solving for the people, if that market is going down, that's the problem. If the market is growing with a particular CAGR rate, that's an area where you look at, how big this would be in the next 5, 7, 10 years. And, what kind of positions this company could occupy potentially if they play their cards right. That's again the kind of the trend. At the end of the day, if these things have to happen, it's a team that will make it happen. As they say, the Andy Radcliffe said it very beautifully. And that is a combination of a team and market. So if it's a great team meets a lousy market, obviously the market wins. And if the lousy team meets a great market, again the market wins. It's only when great team meets a great market, something special happens. That's where you have to look at those kind of companies where it could be fundable. Those are essentially the initial set of filtration criteria the people might put in.
Perfect, Shashi. So you have to reach to the DNA of the organization from your side. Great.
Yeah.
Tejinder, how to identify high growth startups? When you say most of the startups are like bound to fail, so how do we identify the growth oriented startups?
Right. Thank you, Nitin. As the filtration criteria that Shashikant and Ramkrishnan have spoken about, in addition to that, there are certain other factors that I would also like to consider. Of course, these factors are very, very important. Of course, they are essential. But would like to consider a couple of more criteria to ensure that the startup that I'm investing in is a high growth startup. But at the same time, know fully well that unless you are well diversified, you cannot project the future, you cannot anticipate the future. So you need to allocate your portfolio in a manner that that something like Pareto principle will take care of it. 20% of your startups would generate 80% of your revenue, and so on. The first thing that I mean, these criteria have already been covered slightly between these two speakers, but what I like to think of something as non-negotiable and essential before I would like to invest in a company is the integrity of the promoter. If promoters with bad integrity do not qualify, however good the product may be, however good the market may be, however competent they may be, unless you're confident of the integrity of the promoters, it does not. It's the first step. It does not go beyond that. So I think this is something that one has to really look into. Then, of course, a realistic assessment of the market size and of the competition, and realistic assessment of the execution date and all would matter. A few things that I always like to consider in addition to this is do not, and this would be a message for me to all other investors also, do not attempt to invest in an area which you do not understand. You would be a disaster there. So unless that area is within your domain, within your circle of competence, do not do that. And it's a dangerous situation. The figures may look exciting. I've been number crunching and deal counting and handling facts and figures all my life, and the figures look very, very attractive unless you connect it to the reality of the situation. And the reality of the situation may be entirely different. About the spreadsheet and the pie charts and other graphs may show increasing trend of projections, and they are projections, remember. So unless you understand the business model very well, do not attempt to do that. From the perspective of the investor, from the perspective of the startup also, do not approach an investor who does not understand your business model. You may end up getting underfinanced in that situation. So it's a mismatch. It's not the right kind of marriage. So I think that is another thing that you have to keep in mind when you're financing and in addition to the usual things that we do, what I normally like to ask is, how will you attract more customers and make money? And remember, the first answer that some people like to give is advertisement. No, advertisement is not the answer. What makes your product attractive to the customer and how you're going to make money with the product is the question that I like my startup to answer before I decide to invest. And who specifically are going to be your first customer, second customer, third customer? Where would the demand come from? And what are your contingency plans when the seed round is exhausted, which is going to happen very soon? It does happen every time. So you need to have these clarity about these in the mind of the startup before you even take the step further. And the usual questions would be about the projections and all. So I think this summarizes my approach in identifying a high growth, stable, and a safe investment startup.
Great, Tejinder. When we discuss about startups, failures, and the current pandemic situation, which has brought in a surge of a lot of healthcare related startups in different areas, and we are already seeing some of them are pretty much successful with new ideas being implemented. But definitely there are chances where some of the startups do fail. So we have to be resilient about the situation which occurs in the business scenario and embed a design thinking approach in all our uh, activities for new ventures so that the chances of failure are less. So with this, on the same lines, Shashi, I would like to ask, what are the three most important things that matter for investor?
Yeah, I think there could be in the chart in the 3 to 4 things which are going to be very important. First is from an investor's perspective, it's very important, and this could be little counter uh, productive to the startup because the startup founder will have a different vision. But at the end of the day, as they say, the investors love their money, and because that's the primary reason why they're investing in a startup. They love your product, they love your company, no doubt about it, but they love their money first. And from that perspective, it is very important whether this startup investment, is there an exit possible? An exit could be multiple things, whether they get acquired or they get an IPO or they get strategic or they get some kind of a secondary exit. Whatever the exits are there, can this exit? If there is no ROI for investors, they have no investors, very clearly, because that's primarily the reason for them to be inside. So that's number one is the outcome. And the second is what their important thing for the investor is the competitive advantage. Can they develop and maintain that particular market? Because what happens is initially they might have some of the differentiating factor or maybe the advantage over the place, but can they sustain the competitive advantage? Do they have that kind of things? And the third is obviously when both of these two things fail, you have to have a team. That team is so important from the investor's perspective, because that's the place where everything fails, but still this even the startup founders they can rally around, move 11 up and 11 down, and still come out as a winner if they are resilient. And as Dr. Rahul said, the most important thing you need to look at is the integrity. Look at the DNA of the company. One of the advices I got when I started one of my companies was keep the DNA of the company clean. At any point of time, that should not be compromised. If DNA is compromised, the structure is going to be compromised, and eventually it is going to fall out. Some things are going to be discovered, and even if you are doing great revenues, if you are doing the great kind of profitability, all those things on the matrices looks good. But if your DNA is wrong, if something is wrong structurally, the investment options are going to be reduced. And venture becomes unfundable. The moment something is discovered, which is so bad ethically, or on all the lines, whether there are court cases or those kind of things. I mean, the people try to look at, from the industries, how strong is this team in terms of hiring the great talent? If you can hire the great talent fast, it's a very good sign, because at the end of the day, that team is going to make, the company. So these are certain kind of the things which the investor community as a whole will look at. There are many parameters. This discussion has so many dimensions to it, but I'm just trying to limit it to 4 or 5, which comes to my mind at the top of the discussions. So over to you, Nitin.
Perfect, Shashi. The importance of a strong team, members with trust embedded in each other, is really important. And we have seen in all the ventures, you give full liberty to the talent which is there with the team members to explore and implement their thoughts. And that is how ventures have become successful around you. So that's really appreciable. And Rama, coming back to you, I have been part of a lot of fireside chats with you, and I know that you enjoy the quiz format. So I'll be taking up a few questions direct to you on coffee with current style. So be prepared with short answers. Okay, you are having the coffee. I just did my coffee. So the first question on those lines, Rama, will you be interested to invest in ventures which is highly scalability with cash burn model, or will you invest up focused in unit economics with relatively slower or sustainable growth?
My vote is for unit economics with not slower but sustainable growth. Let me tell you quickly, because you said quickly. See, it's very easy to have hyper growth when you're selling a dollar bill for 90 cents, right? When you're selling in discount, right? That's what is a very easy story to do. In fact, when you are going to the investors to raise money, angel, super angel, VC, the first thing that you as founder should have in your mind is unit economics, right? What does it mean, right? It in simple words means what is the revenue on a per unit basis. Let me give some examples so that we are all on the same page. Let's talk of a non-tech venture like Coke, like we all drink Coke and Pepsi and all of that. So for a Coke, a bottle of can, a bottle, a can or a bottle is a per unit. Let's say you go on a movie, right? A seat for an event is a unit. Let's come to some tech ventures. Let's say Google, right? Paid clicks, right? Is a unit, is a per unit. So, so let's come to the ride sharing app, Ola, Uber, right? So if it is Ola, Uber, a paid ride would be per unit. So the first thing that has to be very clear is the unit economics has to be right because that's what investor today really want to sort of bet their money on. Of course, it should be scalable, uh, but they are clearly not willing to have startups which has blitzkrieg cash burn, right? That's not something which will find a flavor of the day. And obviously there are some exceptions. It has to be deep tech. It has to be highly disruptive. In those times, 25 years back, we had Amazon with no unit economics at that time, and longest in the history of the startups to make profit. But my vote is for unit economics.
Great, great, Rama. Thank you so much. And on the same lines, Shashi, we would like to have your inputs.
Yeah, I mean, there are multiple factors at the multiple stages. So, when the company is at an early stage and when it goes to, let us take every stage, is it fundable? I mean, it's not only at the early stage. So you have to look at from those various angles. Uh, the, uh, you know, Before you start looking at those kind of startups and companies, you know, the first thing is we have to look at is how they really find, as Rama was mentioning about the users for the product in a reputable and scalable manner. That's very important. That's two things which I talked about. It's not kind of a one police trick. It has to be a reputable. It has to be scalable. Also, when in the normal terms, what we call it's a very kind of a predictability model that is going to bring in terms of the GTM go-to-market strategies. Second, I talked about in terms of hiring the great talent because that's an early indicator of the kind of things. I would say there is one more equation that comes into the play if you look at it from a different angle. The the equation is maybe the product market fit, which he was referring to, plus unit economics. Number three is a rhythm, whether I'm seeing a rhythm over there in terms of I can see the predictability, whether it's a choppy, something is going fine for 2 quarters and something is really going down 2 quarters. That is not the people are expecting about it. Are you showing us the indicators at the early stage or the seed stage in terms of a non-linear scale, whether that a J curve has started coming in? Are there indicators? So you are not scaled to that extent, agree, but can I see that indications of the non-linear curve that is coming in any kind of acquisitions at the mass level, by some kind of good GTM strategies of the partnerships? Are you seeing those kind of levers which are working in sync? Because these are all levers of the businesses. And is all these levers, if they are working in sync in a repeatable manner, in a rhythmic manner, right? Whether it's a marketing or a delivery or a partnership, if those all things come together, at that point, the startup becomes very attractive because then these are the kind of matrices which have been proved over the last 1, 2, or 3 quarters. And that's where if the levers are functioning in a manner along with the unit economics and the product market fit, I would say those parameters will be very attractive.
Great perspective from both of you, Rama and Shashi. When we have expert speakers who are actually experienced, the moderator's jobs becomes really easy. He doesn't have to do much of his homework. Coming back to you, Tejinder, can I ask you a question? Like when you think of investing, how much should you invest and how much to diversify?
Yeah, I think this is a very, very important question for all the investors to understand. Because I have seen many investors getting excited about investment and then ultimately burning their fingers and losing their shirt also sometimes. So what matters is you need to understand the proper portfolio allocation, which is very important. The first thing that first common mistake that every so-called angel investor is likely to make is to invest in the first company that comes to them. There's some reference, and then you find it attractive and interesting, and then you put your money into it. And since you put all your eggs in one basket, you're going to either get very rich out of it, or you may lose everything out of that. So the first thing that you need to understand is, as I said, as I keep repeating that you don't know at this point in time which of them are going to fail. Many of them are going to fail for sure, and you don't know which of them are going to fail. Some of them are going to give you a very, very high return. You do not know which of them are going to be like that. You will do all your due diligence. You will do all your criteria and filtration and everything, and in spite of that, some of them are going to fail and some of them will give you big money. So which you don't know in advance. So if you know that something is going to fail, you would never invest in that company. So it's as obvious as that. So at that point in time, everything looks good. So what you should be doing is to diversify. I always suggest a 20 to 50 portfolio. 20 is actually the safest beginning point for an investor. When I say 20 investment, and if you have, let's consider if you have only, let's say 20 lakhs for a company, so it becomes, say how much, 40 crore rupees and so. So whatever. So you have to be sure of, so whatever corpus you've got with you, make sure that you are going to invest it in 10, 15 or 20 companies periodically on a regular basis over a period of time. And also that you don't exhaust your full capital in investing in this 20 portfolio, 15 portfolio, 20 portfolio, 30 portfolio, because there would be a lot of requirement for follow-up capital by the companies we have already invested in. So number one, do not jump investing in any idea that comes to you. Vet it carefully, diversify your portfolio, invest in 20. So what I would typically do is when I started my angel investing at a time when this term was not popular, long back, and I would join hands with a group of angel investors, as they're called now, and I would typically invest 10 lakh rupees, and there would be 5 or 6, a consortium of 5 or 6 people who would be investing equal amounts. So 6 of them put together. So my contribution was 1/6 of the angel investment, and 6 people putting together was a handsome sum of money, 60 lakh rupees money for a startup. And this is how I was investing. So I decided very clearly that my allocation is not going to be more than 5% of the total money that I had with me in one of the companies, and would conserve the capital for follow-up also. And gradually, as you start building up your portfolio, your earlier portfolio start giving you returns, and this can be plowed back and so on. So diversify properly, and keep some money for follow-up also. And unless you diversify, and unless you invest in 5, 6, 7, 8 companies, at least you have no right to call yourself an angel investor.
Great. Thanks, Tejinder. Coming back to our quiz round, Rama, what according to you makes a better investable venture? Is it a startup which has A team with a B plan, or a B team with an A plan?
Oh, that was a good choice. You didn't say A team with the A plan. It was a simple question to tick. But clearly my vote would be, besides the point, Nitin, clearly my vote would be for a team with a B plan, and I'll tell you why. Remember, it is very easy to sort of pivot and change a business model early on, right? And if you have a B team, you would never know who moved your cheese, right? So let's take the popular example of Amazon, right? Amazon started 25 years back as a company, as a startup, selling books online, right? And today it's selling almost pretty much everything from pin to plane. Forget the plane, but it's sort of selling everything. So it's very easy to pivot. It's very easy to sort of make that shift. But the team has to be an A team, right? It has to be an ace team, like I said earlier, some of the qualities that I talked about earlier, right? And that's what It is, right. You can always repurpose your team, right? And in these COVID times, you've seen a lot of startups who have repurposed themselves, right? Who have rewritten their playbook and made a great rocket out of it, right? So my vote is for an A team with a B plan. Obviously, the most desired is A team with a A plan, but yes, given the choice that you've given.
These inputs definitely raise some questions in the investor's mind. Shashi, what assumption must be proved before a startup becomes fundable? Your perspective.
Yeah, as I said, the in terms of the assumptions they need to prove is the first, uh, they have to prove that they have a repeatable model of getting the customers. They have to prove that the market size is really big enough. They have to prove they have a unique way of implementing the solution, and they have to prove that they will eventually change the POV, point of view of customers, to adopt this particular product. They have to prove that they can hire great talent at much faster rate. They have to prove that they are not only different, but they are not that incrementally different product, but they are a differentiated product. And that, many of the startups, what we see is that, oh, their product is 10% better than the previous one, but is it sufficiently different than offerings which we see in the market? If they can prove those kind of things to investors, it becomes easy for investors to invest in those kind of startups.
Perfect. A short question, Tejinder. How would you safeguard your capital when you know that most startups fail?
Yeah, Nitin, a very good question again. First thing that I would, as I told you, I would like to have a proper portfolio management when it comes to funding a startup. Second important criteria I would like to reiterate here is the integrity and the DNA, as Shashikant rightly talked about, of the promoters. And when the symphony, as you said rightly, the symphony happens when everything falls in place together. So, what I would additional thing that I would like to do to protect my capital is number one, doing proper due diligence. And we often ignore. We get so excited with the idea. The promoter is excited because he is perhaps technically qualified to explain the new thing that has come up, and it's a disruptive product or service that he's offering. So he's likely to be excited. And we fail to do due diligence in this point in time. So I think this is something that is important for us. Then, to protect your capital, I would repeat, you need to invest within your domain of experience. Do not try to go beyond your domain of experience. If you want, if you're interested in a particular domain which is not within your circle of competence, I advise people to learn about that. Make it a part of your circle of competence. Unless you do that, do not try to invest in that domain. And you can broaden your circle as much as you want, but you have to do your homework. You have to really work hard. You are becoming an entrepreneur by remote control, a proxy entrepreneur. So you ought to know as much as that entrepreneur knows about that business. Otherwise, you do not invest in that. And then one big mistake that people are making. Rama talked about dot-com boom and bust, and that was a lesson for us to learn. And every time there is an exuberance in the market about a particular product or a particular technology, people tend to invest in that in a very high valuation, and that happens to be a big mistake. So financials do matter, in spite of the fact that we have come in a world where figures are relegated into one of the criteria, small criteria for the total overall picture. But the fact remains that the financials still do matter. Bottom line still does matter. Even if you're burning your cash over a projected period of time, ultimately you have to make your money. As Rama rightly said, it's very easy to sell a 100 rupees product for 90 rupees. You can generate a huge a top line by doing that. But when it comes to bottom line, ultimately what matters is how much money the company is going to make after deducting all its expenses. So valuations have to be commensurate, and this is where we often make mistakes. And finally, I always like to do a thorough vetting and discuss with my lawyer before I sign all the documents. So I think this is, to a startup, this may look like an expensive process. To a new investor, this may look like an expensive process, but I think this is an important part of the process. Do not sign any document before you engage your lawyer who understands what you're doing and the business model and the process of investment that you're doing. And I think this is, and finally, I will also like to make sure that I reserve additional capital to all follow-up rounds. Otherwise, because of my unavailability of capital at future date, the startup may face lots of problems. So even if the startup does not tell me, I know there's going to be a requirement of money in future. So I think this is, I have to provide for that. So I think these are the things that I normally employ as criteria for finding a stable and a high growth startup.
Great, Tejinder. Rama, our quiz continues. What kind of startup would you invest in? Non-tech ventures, tech-enabled ventures, or pure tech ventures? Your take on it.
Okay, so I'm for me personally, I'm agnostic to this, and I'll tell you why. There can be successful startups like Starbucks, valued little less than $1 billion, right? It's a non-tech venture. There can be tech-enabled ventures like Oyo, Ola, right? So amazingly successful. And obviously there are deep tech companies, there are Googles of the world, right? So I'm personally agnostic to these things. You have kept it short.
Thanks for that. You saved our time. Shashi, what startups must start doing for their venture to become fundable?
There are, I'll start with a couple of things. The one is there are two simple rules. The first, and those have to be followed very diligently, taking off the cue from Rama and Tejinder. The first one is at certain stage of the company, the startup has to make profit. It has to make money. And rule number two, make the first rule. So that's a very sacrosanct in terms of like the what startup should be doing. The second is the product. Even the product is not this. Product is important in the whole scheme of the things. The product is important, but product is great. But product is not the business. The VCs want to back the entrepreneurs who show whether they can build business with this product. And many of the startups only focus on the product. They say, hey, guys, I have a great product, and that doesn't necessarily guarantee that they will be able to create the big business. The third thing, which is important, I think it is talked n number of times, and I just cannot, for the sake of it, again, not to repeat it, but I have to still repeat that, is the focus. During the early stage, or rather the early stage, but the early stage is very fragile. And it's very, very important to really focus on very few things and do it right. Maybe 2 or 3 things. If you're doing it right, instead of trying to do too many things, just to conjure up the valuations and to show the investor that this company might be so big in the next 5 years and 7 years, and that's the reason why the valuation of this company might grow. You don't have to get into those kind of focus is so critical. And the focus during the different stages of the company are going to be different. And that's where when in terms of the startup becoming the fundable startup, at the early stage, when it's like, when you are very, very early, you have to really start focusing on the core problem at the seed stage. When you get into a Series A stage, you are more focused on scaling into the multiple markets. If you are into a Series B, then you are more in terms of like, looking for those adjacency, where you have to focus. That's going to be very important. And the last thing where I want to conclude is the customer validation. Many of the companies or the startup we see, they go about in terms of the product validation. They create a product and they end up creating a product which is aimed at a particular point and the customer is requiring something else. It's very, very important that you do the customer discovery process and you have the customer validation coming in. That's where the proof of the pudding, where the dollar value gets exchanged with respect to a product. If that cannot happen, irrespective of what great product, what great team, what integrity and everything, unless there is the startup which cannot make money. And the last one is, if you can't prove that you cannot make money with your own money, forget about taking others.
Great. Thanks, Shashi. Rama, I have a question for you. You always keep talking about the jargons in the startup world, like unicorn, dragon, camel, and so on. Can you quickly demystify them?
Yeah, Nitin, that's a good one because the startup lexicon, the startup world is all full of biblical and mythical jargon and animals, right? Let us talk about three, four of them which randomly comes. I mean, some of them are extinct for more than 30,000 years now, right? We all know unicorn. Let's come to Decacon. A Decacon is a startup which has upwards of $10 billion in valuation. A short example is, a quick example is India's own Baiju, which recently became the third Decacon in these pandemic times. The first two being Oyo and Paytm. Let's come to the Dragon startups, right? Dragon startup is a startup which raises about $1 billion in a single round, or more popularly put, a startup which returns $1 billion to its investors, right? That's a Dragon startup, right? What's a Dragon startup? Example: Flipkart is our own Dragon startup. It returned more than $1 billion to its investors. Let's come to some very relevant ones in these times, and this conversation is going on across the startup ecosystem, right from Silicon Valley and so on. So, do you need the unicorns, or do you need a different kind of animals, right? In these pandemic times, COVID times, challenging times. So there is this concept of this camel startup, right? Camel, uh, as you know, comes in many shades of brown, right? Right from cream to a dark brown, right? We all know that. So a camel startup is a startup like a camel can cater to a portfolio of diverse customers. Let me give an example. Zoho, we all have been using Zoho, each one of us. So Zoho caters to a multinational, a blue chip multinational with equal ease, and to a startup with the same amount of ease. So camel startups are the startups of are the flavor of the season in these pandemic times, right? Then there are zebra startups which focus on doing things fundamentally right. They do not believe in disrupting. They are a shade of black and white, as zebras are. And obviously there has to be a good social good, a societal good angle, a double bottom line, triple bottom line kind of thing. M Pani comes to my mind randomly from an Indian startup ecosystem, which is a zebra startup. So there are a bunch of others, but definitely I would like to sort of take just half a minute on this, right? Indian startups ecosystem is maturing and very fast, and soon we'll be there in the second slot of one of the most matured startup ecosystems in the world. So it is not, that time is not far off when we will have startup lexicon of our own. Maybe Kamadenu startup, right? For a startup which has positive EBITDA, right? Or a positive free cash flow, right? Or you can have a Hanuman startup, right? Which is Chiranjeevi and it doesn't die. You can even have names like Garuda startup or a Munshika startup, right? All kinds of lexicon, I'm sure, are going to be coined and invented as we go on. Thank you, Nitin.
Thanks, Rama. Thanks for sharing that. We have a participant question here which specifically asks, do investors ask for any mortgage or interest on money invested? Shashi, I would like you to address this.
No, in a classical startup, when we say the classical fundings models, unless it is good, unless it gets to a debt funding kind of a model, because those are hybrid models also coming in with respect to the fundings. But classical models of the funding is where you do not expect any kind of mortgages, you do not expect any dividends. Also, normally you do not expect, to return the money, because you are, as an investor, you are also taking a risk. So it is not like the fixed returns that would happen every year or every month or those kind of things. 2% per month or 24% per year. This is not the game for the classical investments. They are also sharing the risk and reward with you. Yes, some of those players who invest, they will have their conditions. At the time of exit, how much return they can get, whether there is a preference or a con, whether there is a multiplier or not. Sometimes the investors come with a 2-time multiplier, whether there is a floor or there is a cap, whether there is a carry. These are all technical terms, but these are the type of things which will come at the time of exit. But plainly speaking, nobody would ask you to mortgage your property or home. Nobody will ask you to return that money if the things don't work out normally. They would also ask you to give me 2% interest every month. So that's the kind of scenario for the startups.
One question, Tejinder. Need an answer in just 1 minute.
Yeah, sure.
What are the warning signs of a weak founder? The top 3.
Yeah, okay. The top always is, I keep repeating, and even at the cost of repeating, that the topmost is perceived lack of integrity. It's a disqualifier initially for me immediately. And I would very quickly give you a couple of more that come to my mind. Is unrealistic assessment of market size and unrealistic assessment of offerings by the competitors, unrealistic assessment of execution challenges, unrealistic financial projections. They normally have come out with very, very unrealistic financial projection, unrealistic valuation expectations. Because Uber has been financed at this PE multiple, I should also be financed at that PE multiple because I belong to the same trade and so on. Unrealistic fundamental business idea. If you as Shashikant rightly said, unless the real test is when the rubber meets the road. Unless you're able to sell it, it does not matter. So even if you make the best product in the world, it would become a toy shop which does not sell anything. So it has to have that experience. Lack of domain experience is another thing that I always think of as a disqualification. Lack of technical expertise, lack of long-term vision. A promoter who creates a company just with the intention of exiting the company at the soonest at a higher valuation would not have the long-term vision about the company. And finally, the lack of historical knowledge about the market space. You are just a new kid out of the block and you just think that everything is goody-goody and you don't understand that historically how the markets operate. So I think these are some of the quick criteria that I could think of.
Great. Thank you so much for a wonderful discussion today and your expert inputs on the topic. We really enjoyed the journey and got a lot of insights from your life learnings which you have shared here. One understanding what I get from this discussion is when we talk about pivoting, first of all, we should know the startup where we are investing. And if things are not going in the right direction, we should pivot without mercy or guilt, understanding that the invested sum is already a debt cost. It's a sunk cost, basically. We should not keep on investing further or seek investment from other people where we see that there is clear visibility that the startup is not going to perform. So this is one input what I wanted to give on the investor perspective. Any startup, whether it is bootstrapped or angel funded, needs to think over the business plan, the problem that they are solving. And if the problem is easily identifiable and people can understand the business concept and it solves the problem of the public at large, so things are pretty much straight and businesses can become successful. So with this, I hand it over to Nidhi for the closing remarks. Thank you so much. Thanks all the speakers. Thanks all the participants. And from TGS at TI Global, we thank everyone for attending this session. See you soon.
Thank you so much, Nathan, for the wonderful moderation. And thank you so much, all the speakers, Ramakrishnan, Dr. Tajinder, Shashikant Chaudhary. Thank you so much for your wonderful deep dive insight on the topic. So thank you so much. And thank you so much, all the participants, for joining different parts of the world. And the next session is coming up soon. So thank you so much.
Thank you. Thank you, everybody.